Look at this visual. In a world of instant global communication, people are still standing in lines like this to access the $800 billion global remittance market. For the privilege of sending their own money across a border, they are taxed an average of 6%. This friction is rarely the result of slow wires or outdated technology. To find the real source of the fee, we have to look at the broken unit economics of the companies processing the transactions. Take a look at a traditional money transmitter's balance sheet. Their first massive expense is localized legal compliance. To operate legally, they have to build and maintain KYC, know your customer, and anti-money laundering infrastructure in every single jurisdiction they touch. On top of that, they spend tens of millions of dollars on marketing and advertising just to acquire a single user. Between this customer acquisition cost and the regulatory overhead, the company is mathematically forced to set the consumer fee at 6% just to stay in business. This creates an unsolvable dilemma for modern fintechs. They can build a prettier app, but they cannot lower that fee without going bankrupt. The overhead costs are built into the foundation of their business model. SigMa BankAI, or SBAI, claims they can drop cross-border transfer fees to absolute zero. They achieved this because they didn't try to optimize the legacy banking rails. Instead, they built a decentralized protocol that structurally eliminates those two massive overhead expenses. SBAI's first major structural hack is a process called decoupling. They engineered a way to remove the heavy regulatory overhead from their own balance sheet. Most Web3 projects fail early because they try to manage their own fiat on-ramps. The moment a crypto app touches local currency, it triggers a global legal nightmare, requiring licenses and compliance teams in dozens of different countries. Instead of building a compliance engine, SBAI integrated MoonPay as a regulated shield around their network. MoonPay runs global identity verification and fiat gateways. Data reaches the SBAI node as a verified digital asset, completely bypassing local banking laws. By completely outsourcing this legal friction to an established infrastructure provider, SBAI effectively erases regulatory compliance from their operational costs. The first half of the traditional banking trap is gone. So what happens to the money immediately after MoonPay converts that local fiat into a digital asset, like a stablecoin or SBAI's native altcoin? If those assets were dumped onto a public crypto network, the transaction would be eaten alive. Volatile gas fees, extortal intermediate wallets, and open market slippage can destroy the value of a remittance before it ever reaches its destination. To prevent this, SBAI built a closed-loop network architecture. As you can see, these validator nodes operate inside an encrypted, self-contained highway that is completely quarantined from the chaos of public blockchains. For the user, the funds move instantly from the sender's node directly to the receiver's node. There are no intermediate banks taking a cut and no public miners charging a network toll. This quarantined closed-loop system is the technical foundation that drops the actual transaction cost to zero, and a zero-cost transaction perfectly sets the stage for their aggressive growth strategy. SBAI still had to eliminate the second massive overhead cost, the customer acquisition cost. They do this by turning their zero-fee transactions into the ultimate marketing magnet. Think about the sender's incentive. If you need to send money to family overseas, you have an immediate, high-stakes financial motivation to use SBAI solely to bypass that traditional 6% international wire fee. Now, look at how the network map expands. To claim those funds and off-ramp them back into local cash, the receiver downloads the SBAI app and synchronizes with the MoonPay shield. This creates an organic, self-sustaining loop. Every single person sending a remittance effectively acts as a highly motivated unpaid sales rep, forcing the network to expand simply by executing a transfer. This Trojan remittance mechanism drops SBAI's customer acquisition cost to a literal zero. They completely eliminate the massive advertising budgets that plague traditional fintechs. Compare the final unit economics. SBAI has outsourced their compliance and eliminated their marketing budget. Because they have zero overhead to recoup, they can sustain 0% fees indefinitely. Traditional banks are mathematically unable to compete with this structure. Traditional remittance companies face a structural dead end. With zero marketing spend and outsourced compliance, SBAI systematically removes the margins legacy transmitters need to survive. The final layer of the architecture transforms the nature of the wallet itself. By leveraging MoonPay's non-custodial framework, SBAI turns a standard ledger into a sovereign, programmable bank designed for autonomous agents. This animation shows a SigMa agent in action. These AI entities live directly inside the wallet. They can automatically dollar-cost average or deposits, swap for stablecoins, and execute recurring cross-border payouts completely without human intervention. Global money movement has evolved into a quiet, automated background process. In this system, compliance is a simple API call, marketing is an inherent network effect, and transfer fees are permanently erased.